Back in 1952, Nobel Prize winning economist Harry Markowitz said that diversification is the only free lunch in finance. And this video, I'm going to look at how you can diversify your portfolio to improve your trading results. This is Mark from TradeInform.com and welcome to this video. In this video, I am looking at how you can apply a trading strategy to a portfolio of markets. And I'm going to take the example of the US stock sector ETF to see how we can optimize not just for one market, but how we can optimize for a range of different markets with the intention of improving your overall profitability. On the screen, you can see an example of the strategy that I am testing in this video. I'm using the RSI indicator, which is one of my favorite indicators, although you can literally use any indicator you like, just copy and paste it into the model, which I will demonstrate soon. This is a long only strategy being demonstrated in this video, and the entry is when the price closes. RSI is based on the closing price, so the RSI goes from below to above a set level. And I'm using an entry level here, shown on the chart of 55. On the screen at the moment is a TradeInform backtest model. Now this is an Excel-based backtesting system that you can use to backtest your trading strategies and apply quantitative techniques to improve your trading. And if you think about it, that means you can develop new strategies. You can improve the results for your existing strategies. You can test different settings, different stops, different targets in a safe and easy to use environment. So what I'm showing in this video is we're looking at the sector ETF. So I have chosen 7 ETFs here: XLK, XLY, XLF. And what I'm displaying here is the results for the XLK. So this is just one of the ETFs. I'm using an RSI based entry system, and that's adjustable. So I'm using an RSI entry level of 55 with 25 number of periods. Now if I choose to, I can change the number of periods here. And as you can see, the results will update in real time. Now some of the ETFs will respond better to certain parameters, of course. So I can change this and it makes quite a significant difference, but I'm just going to put it back to my original setting for the time being. I'm not looking at net profit specifically in this video. Of course that is important, but I'm interested in the free lunch. I want to look at the diversifying my portfolio. So I'm using an RSI level of 55, and what this means is, if you're familiar with the RSI, this is a fairly slow moving indicator. So 55 is when the market's going fairly well. It's humming along, it's not zooming, but it's going fairly well. So 50 would be the average value. So I want it to be going slightly better than that. Now I've got a few other things here. I've got a profit target. I'm using the ATR, the average true range, which is a profit target and stop loss that adjusts to volatility, it adjusts to market conditions. So you can see all the settings here. I've selected the ATR here. If you want to, which you should do before trading any of these strategies, you should apply commissions, cost of trading, but I'm just doing a pure test for the purposes of this video. Now I've got a profit target multiplier here set very high, it's not going to be hit very often, and I've got a rather large stop loss, 5 times the ATR, and a trailing stop of 5 times the ATR. So the idea is that if this particular price move goes, we've got a trailing stop underneath to take profits. Now I've got a few other things here. I have a time-based close. So the number, close after the number of consecutive bars. I'm testing on the daily time frame here, so this would close after 40 trading days, which is a little under 2 months of trading. I've also got one of my favorite closes, which I tend to have in most models, and this is a strength close, what I call a strength close, and this is 2 consecutive bars with at least a 1% gain. Now, we can see here that a strong market, we don't know this in advance, but historically XLK technology stocks have been amazingly strong. So 3 consecutive days at 1%, if I put that to 4. See, we may be hitting the sweet spot here, but again, I'm going to put it back to my original settings. So we can easily tweak it. This will show you how easy it is to adjust these models. I've got another close. I've got an RSI close, which isn't doing a huge amount, but it's basically when we have an exuberant market condition, have an RSI of 75, then we're going to close that trade. Okay, I'm taking long trades only, just pointing out the most relevant things here. Taking long trades only. I'm using all the historical data from January 2000 to 2021, so we've got a long historical period there being tested. As I said, these are the results for just one market. But what I want to do is I want to get my free lunch. I want to get my portfolio. So, a new feature that has just been introduced in this model. And don't forget, this is available as a free download for Trade Informed members. There is information below this video if you want to find out more about that. And I'm going to click this button. Now, it doesn't take very long to update, but I am going to speed up the video. Once the backtest has completed, I have a readout here showing me all of the results at the top here and all of the settings. Now, all of the settings are exactly the same because I'm testing the same thing on each different ETF. So XLK, XLY, etc. I'm only testing 7 here for the purposes of this video, but we can see some interesting and striking features. Firstly, if I'm measuring along here, I can see that, yes, we're taking a long view, but each one of these individually was profitable. Each one of these showed a profit factor of at least 2, which means that the gross winning trades exceeded the gross losing trades by at least a factor of 2. Some of them much higher, like XLK. But we can't always rely on something like XLK to bail us out. So we want to have the portfolio exposure. Now, percentage winning trades. We can see down here, a simple average of these strategies shows we have just over 60% percentage winning trades over our portfolio. We're looking at the MAR ratio. I usually like to look at the MAR ratio, but I'm not so interested in this video because I want to look at each of them in turn. So I think something that is important is the average trade expectancy, because we're trading more than one market. We're testing more than one market, one ETF. So we want to only get the best quality trades. So this is one of the key metrics that I want to get as high as possible, because we have that option here. If we're just trading one market, we may have to take trades that aren't always optimal, but maybe still profitable. Here we want to take the most optimal trades. So we want to get a high average trade expectancy. Percentage of time in the market. So this is showing that I can get a simple average again. We've got an average of about 45% over this time, and that depends. Now we can try and tweak both of these values. So if I go back here to the results, we can see that average trade expectancy, very good for XLK, and percentage time in the market is about average for the 7 sectors that I have tested. So we can do things like we can reduce the amount of bars that each trade is open for. So if I reduce this to 20, we can see that our average trade expectancy has decreased quite considerably, and it's not had a huge effect on our percentage time in the market. So I can say that, well, maybe 30 might be a halfway house. But we can see really here 40, 50. Yeah, maybe 40 is something of a sweet spot here. We don't want to be in the market unless we're in an optimal trade. So make that as an absolute principle. If we're trading, we've got a huge range of potential markets. So why do we want to be in suboptimal trades? We want to be in good trades. So average trade expectancy, I want that as high as possible. Percentage time in the market, I really want it as low as it can be while still giving me the exposure to get me to have a decent expectancy. So it's no good having it at 0, but on the other hand, we don't want it at 100% as well. So we want this to be as low as reasonably possible. So if I adjusted something like the RSI close, I would expect to see a reduction in the percentage time in the market down to 38%, average trade expectancy, and there again. So this is the sort of thing that I am looking for to try and get a portfolio strategy. So you can see just for this simple strategy that we've got here using the RSI, let's have a test here, RSI number of periods. What would happen? We saw earlier that having a shorter RSI gets us into more trades, increases our net profit, but doesn't increase our average trade expectancy. However, if we're getting more trades, then we still want to do this. We're in the market more frequently. So for XLK, that's a good thing. So let's have a look. Just one simple change here. Let's have a look. Let's run all the data again. Once again, I'm going to speed it up and we're going to have a look at the results. We can have a look at the net profit in this scenario. We have a higher net profit. We are now averaging over 300,000. I'm not so interested in the numbers, but more how they fit together. Our percentage winning trades is broadly similar to what we were showing before. Our average trade expectancy is slightly lower, and we have a slightly higher percentage time in the market. Now, this is an example of what I was talking about. If we have a range of markets that can be as wide as we want it, we can trade as many markets as we want, we need to be choosing the very best trades from each of these markets. So we've got a slightly lower trade expectancy. Everything else being equal, we're making greater profit, but are we taking on, the question to ask yourself is, are you taking on more risk for the extra profit? Is it worth the extra risk? So this is the advantage of testing the whole portfolio. We could test 30, 50 markets, however many markets we want, but we want out of each of them, we want to take the very best trades. And as a principle, I would suggest being in the market for as little time as possible to achieve that. So finishing this video, if you were using this model and you just wanted to test a different market, so let's have a look at XLY. It's as simple as unchecking this, and then we can look in detail at that market. We can also use the built-in optimizer. So we've got XLY here. Doesn't look like, looks pretty good here. We haven't optimized this market. We've optimized for the portfolio, but if we wanted to, we could have a look. RSI entry level here. So let's go and select it. RSI entry level 55. What happens if I looked from 50, let's have a step value of 1 to 60. I'm going to optimize for net profit out of those options. And we can see in real time the different RSI entry levels. So we were entering here, which is a light green spot, suggesting it's pretty good. For this particular market, we might have been better for a lower entry level, lower RSI entry level, somewhere around 50 or 51. Now we can do all this. You can do all this in the same backtest model. Now, I hope you found this video useful. I said I was about to end, and I am, but I can give you an example. Look, I have a selection of stocks here, and easy to test those. These are the sectors. If you're a currency trader, you can test different Forex pairs. You can test whichever markets that you want, whichever markets that you have data for, and the model will update and run each of them consecutively. Now, I hope you have enjoyed this video. If you want to learn more about backtesting the financial market, about becoming a better trader, please go to tradeinformed.com.